Hi, this is Andy Filipiuk in Toronto for the week of March the 14th. Well, we finally got it. The interest rate increase from the Federal Reserve came this week where they raised rates from 1/4 to 1/2%. But what's interesting from the Fed meeting was just how bearish the talk was. Specifically, the Fed has indicated they're going to raise short-term interest rates 7 times this year, which means at just about every meeting we're going to see a 1/4% hike on the rate. Now, that would take the Fed funds rate up close to 2%, and that's exactly now where the 2-year bond yield is. So the markets are building in these higher rates. It's interesting to note, though, after the Fed announced this, that the yield curve started to flatten, meaning longer-term rates didn't go up as much as short-term rates, which indicates that the market might feel that these rate increases will slow the economy and hence possibly lower the inflation rate. But again, with the war in Ukraine right now and the liquidity needs of a global economy that's been sort of stymied by COVID and supply chain problems, to be raising rates and taking liquidity out of the system, it remains to be seen whether they will be able to do this. And this is where the skepticism comes in, because some of the projections that the Federal Reserve is making are quite optimistic for their own case. Specifically, I wrote down here that they expect inflation to be at 4.3% by the end of this year. That's very, very optimistic. And by 2014 should be down to around 2.7%. So that's building in a very, very optimistic case for their inflation numbers. And remember, at any potential time, this Fed forecast could be reversed if markets get worse. But as far as equity prices and asset prices are concerned, a tightening Fed may be a bit of a dangerous thing here, so caution is warranted. We'll keep you posted on developments. Thanks for watching.